My name is Chuck Whitman, and I build great traders that lead great lives. Traders I've trained have generated in excess of $1 billion in trading revenue and are found at some of the largest proprietary trading firms and hedge funds in the United States. So look at this. This is Trader Tip Tuesday on the road. That's right. And today we're going to talk about a secret strategy that hedge funds use to outsmart the algos. So what is this strategy that I'm talking about? What is this secret strategy? First of all, let's step back for a moment and let's talk about how the interplay between a big order from, let's say, a hedge fund or institution and then an algo works. There's a lot of nuances to this, but the general premise is that the algos are always watching the order flow coming into the market. And they're always not only watching for it, they're trying to make sense of what it sees. And if they see some kind of pattern in which they recognize that there's consistent buying or consistent selling, then that algo will start buying ahead of it. And the idea is that they'll buy up the contracts that are available or the shares that are available ahead of the algo, such that as the algo continues to buy, they'll be able to turn around and sell out the shares that they bought or contracts that they bought for a profit. So there's a constant game going on. It's a little bit like poker, a little bit of bluffing, a little bit of gamesmanship that's going on. And now it's happening at the highest of levels, using artificial intelligence and using very sophisticated algorithms to try and hide and detect. So if I'm a big hedge fund and I need to buy 100,000 contracts, let's say of US Treasury notes, I'm not going to go in the market and buy 100,000 in one shot. I'm going to disrupt the market. So what I want to do is I want to be kind of stealth, and I'm going to pick somewhat of a rhythm or lack of rhythm for that matter of how I'm going to get this order done. Typically, the way this works is the hedge fund runs their own algo. You have TWAPs and VWAPs, and essentially a TWAP is a time-weighted average price where every certain amount of time, certain amount of contracts are bought, or VWAP is a volume-weighted average price where it's always sensing how much volume is available in the market versus how much volume needs to be bought. The really good algos use a combination of both. They're always looking to see, is there liquidity in the market? If yes, take it. If not, we'll have small bids in the market. But there'll oftentimes be a timing component to it that'll say we're going to buy X amount of contracts every minute or every 5 minutes or every hour, whatever the case may be. So the hedge fund's trying to hide and the algo's trying to find. Now, when you get a big position on, one of the things we always talk about, you can always get a position on. That's not such a big deal. The question is, can you get out? That's the issue. Where algos are really a problem isn't so much trying to get your position on, it's when you have to get out. Because when you have to get out, there tends to be a higher sense of urgency. And the higher sense of urgency makes it easier for the algo to understand your intention and then race you. So we start to understand a little bit of this interplay. So what's the secret strategy? Well, a hedge fund, let's say in the 10-year note, a hedge fund can choose to execute that 10-year note by buying the future, or they can also go on the options market and they can do various option strategies and execute their order there. Now, depending on the type of order it is in option space, that's going to be detected by algos as well. And a lot of these, if you buy calls, well, the market maker who sells calls to you is going to now have to buy futures against his short calls. And now the algo will pick that up. Right. So a lot of what goes on is the market maker is trying to always do things that they never have to hedge. So they're laying off somewhere else or they're waiting. Right. So rather than just if I sell calls, I don't just turn around and buy futures. I'll sell calls or I'll buy some calls or I'll buy some call spreads or I'll sell some put spreads, either in other months, other strikes, or maybe even in other products. Now, when we look at all the various option strategies, a strategy that's recognized widely as one of the safest is called the butterfly. Butterflies are recognized as being very safe, especially if they have a lot of time. Now, butterflies near expiration can be very volatile. That's not what we're talking about. We're talking about out in time. So if I'm a hedge fund and I need to buy 100,000 10-year notes, and I say, I think if this trade works, I'm going to be in this trade for 3 months. I can go in and try and buy the 100,000 and I'm battling the algos and doing my thing and they're doing their thing and it can be hard. Or what I can do is instead I could come in and say, all right, where do I think 10 years are going to go? Right now it's trading 109.06. Well, maybe by my models, I look at it and I say, well, I think the 10-year is going to be trading 113 in 3 months. It's going to be 4 points higher. So I can buy 100,000 contracts, ride them up to 113, and then I have to come out of those 100,000. Or what's really a bigger issue is, let's say the trade doesn't work right away or pretty early on, and now market's going down. and now I got to sell 100,000 futures. Well, now this is what I'm saying. This is where the algos really feast on you. So it's hard to get out. Everyone wants to have a 1 hour loss. Well, when you got to sell 100,000 futures, you don't know what you're going to get. Maybe you get a 1 hour loss. Maybe you get a 2 hour loss because they're just racing you to get out. So what's the secret strategy? Well, if I think 10 years is going to go to 113 and I think it's going to do it in the next 90 days, well, I might go and get a quote on, this is January. I might go look at the April options and say, okay, I want to get a quote on the 112, 113, 114 call butterfly. Now, the market maker, because the butterfly is considered one of the most conservative of strategies, and it has an arbitrage relationship to it. This is big. Anytime a product has an arbitrage relationship, that relationship will help keep it in line. And in some respects, it builds a lot of liquidity into it because that relationship is free money if it gets out of alignment. So with a butterfly, it is framed by an arbitrage relationship, and on its own, it's a very stable spread. You're not long a lot of volatility. You're not short a lot of volatility. It doesn't have much theta. It doesn't have much gamma. It doesn't even necessarily have much delta in the ones that we're looking at. So if I want to buy 100,000 futures, that's going to be hard, especially getting out. But I might say, okay, I'm going to buy the 112, 113, 114 butterfly, and I can quote this. And if the market maker is quoting this to you, I know for me, whenever I was quoting butterflies to customers, I was like, this is going to be awesome. In a lot of respects, market makers will view a butterfly as free money to them because it's so stable that any edge to their model, let's just say this butterfly, for argument's sake, is worth 30 cents. Okay. If I can sell this butterfly at 35 cents and my model says it's worth 30, I'm looking at it, it's like 5 cents. It's kind of free money. And so when these big butterflies would come in, we do them big. We trade them big because we got them on. We kind of get this money right away. And now we have a lot of inventory, but we have 90 days and we're trading all the time. And over time, we'll find a way to trade out of that. So what ends up happening is the hedge fund that wants to buy 100,000 equivalent of 10-year notes, they might go out and look at this butterfly and say, okay, you know what? What's the market in this 112, 114 butterfly? Now, in treasuries, it's quoted in 64ths or 128ths, depending on which one it is. So it's a little more complex, but let's just keep the math simple. It's a 2-point butterfly, and let's do it in cents, just so it's simple. So it's a $2 butterfly, $1 wide, 112, 113, 114. The most it could be worth is $1. All right. So you might come in and quote it, and it might be worth 10 cents. And say, okay, what's the market on it? And I get 9 bid at 11 or 8 bid at 12, something like that. And so it's not worth much and it's tight. Now it has a small delta, but what I'm really looking at is the long game. If I go to 113 in 90 days, that delta is going to really take off. So let's just say the market's 9 bid at 11. I'll say, well, how many can I buy here? And I can find out that I can buy 200,000, 300,000, 500,000 butterflies. Now, is there an algo checking that out? A little bit, but not anything like the other stuff we've talked about. So I'll say, okay, well, you know what? I'll buy 300,000 butterflies. Now I've got 300,000 butterflies on that. If we rally and we go to 113 in the next 90 days, that butterfly starts to come in the money. It's going to start to act like 300,000 futures. That's right. A position 3 times bigger. Remember, I was able to get it on like that. Now, the great thing about the butterfly is it's got a limited risk. The most I can lose is what I pay for it. So if I pay 11 cents, that's the most I can lose. So the market goes down. I'm not looking at a huge loss. I know what I can lose. If the market goes down, I'm not uncertain about my ability to get in or get out. I don't have to do anything. I can take my time and decide. Maybe if it goes from 11 to 5 cents, I say, I don't like it. It's still going to have a ton of liquidity. So now if we go down to 5 and I come back to the market makers and say, what is it now? They're going to say, oh, it's 4.6. Okay, I'll sell you 300,000 at 4 and I lost 7 cents. I'm done. Super simple. If the bottom fell out of treasury note market and it collapsed, most we can lose is 11 cents. We're totally fine. We're in great shape. This is trading from a position of strength. Now, flip side. If we rally up in there, anytime I have a trade that's working, especially in option space, I got options. I got choices of what I can do. So I could be buying that fly at 11, and then I could start selling some out at 44, 55, 66. So just kind of scale out, sell it as it starts to work my way, and then I don't have to worry about all this sort of thing. Or maybe it starts to get inside, and I could do some creative things to roll the strikes around. Now, it could be a very hairy thing if I don't do anything and then we're trading around the strikes. But I got 90 days to figure that out. And if it does, it's a good problem to have. Because think about it. I paid 11 cents for a butterfly that could be worth 89 cents. It could be worth $1 minus 11 cents I paid for it. So I'm looking at like an 8.8 48R winner if it hits at max peak. That's freaking awesome. A lot of hedge funds use these. They use these as a way to get really big positions on without having to be raced by the algos. They're very low risk. They can get in and out of them. And the only time the liquidity starts to be a big issue is when it's working. And again, which they have options of how they can address that. I want to show you a scenario between three different strategies. We're going to look at a long call spread, and a long call butterfly. And we're going to look at the payouts on these. This is a trade that we have in one of our systems we call the VIX Spike. And the VIX Spike's an awesome system. It's something that we've traded since 2014. It's something that we have data going back on it to 2005. We know the system really, really well. So when we go look at this, I'm going to share my screen. What we have here is we've got three different option strategies on the exact same underlying expression. So as I said, this is our VIX Spike strategy, and we get an entry date to go long SPY on March 5th, 2024. So all three of these strategies are going to go long on the close of March 5th. SPY at that time is trading $507.18. So that's, if we bought SPY, that's what we'd be paying. But instead, we're going to do options. The expiration we're choosing here is a 1 week option, 7 days to expiration. So we're choosing a March 12th, 24 option. Then what we do is we go see, okay, where's SPY at expiration? So 7 days later, where's SPY? Well, SPY has rallied from 507.18 to 516.78. That's where it moved over those 7 days. Now we're going to go through and we're going to look at the strikes we choose. So we're going to buy the call. We're buying just the 513 call in strategy one. We're buying the 513 call. This is a 28 delta call, and it's worth $1.59. So in strategy one, we buy the long call. We pay $1.59 in premium. Now we're long the call. Strategy two, we do a long call spread instead of a long call. So we're going to choose the exact same strike to be long. We're buying the 513 call for $1.59, but against it, we are selling the 517 call at 69 cents, both of them expiring March 12th. We are selling the 517 call at 69 cents, and it is a 16 delta. The third strategy is the strategy we're talking about today, which is the long call butterfly. In the long call butterfly, again, we're buying the 513 call at $1.59, 28 delta, but now we're going to sell two of the 517 instead of one. So we're going to sell two 517 calls at 69 cents. There's 16 deltas. So we're collecting $1.38 in premium on those shorts. Then we're going to come out, we're going to buy one more call. We're going to buy the 521 call. In the 521 call, we're buying this for 27 cents. This is an 11 delta. Okay, so the price of the package of buying the 513s and the 521s and selling two 517s is 48 cents. So you can see in column Q, we pay $1.59 for the call. We paid 90 cents for the call spread, or we pay 48 cents for the butterfly. Okay, three different prices. We're all getting long at the same price. We're entering at the same price in SPY. We're getting out the same day and the same price in SPY. All right, so we go to expiration. And at expiration, we expire $516.78. So our 513 calls, they're $3.78 in the money, which is going to be less what we paid for them of $1.59. Our 517 calls are all worthless. They're out of the money. They are worthless. And the 521 calls we bought, they are worthless too. So let's go through and look. So the call ends up being worth $3.78 minus the $1.59 in premium we paid for it, or a exit price, a profit of $2.19. So 219 divided by the $1.59 that we paid is a 1.37, 1.38R winner. Now, the call spread that we paid 90 cents for, it goes out worth $3.78. So we have to subtract the premium of 90 cents from that. That's $2.88 divided by 90 cents gives us a 3.44R winner. We take $2.88 divided by 90 cents, and it's a 3.2R winner. Lastly, we go to the butterfly. The butterfly also expires worth $3.78. We subtract the premium paid of 48 cents. That's a profit of $3.30. We divide 330 by what we paid of 48 cents, and we get a 6.88R winner. 6.88R. So look at these three strategies. The call pays 1.38, the call spread pays 3.2, and the butterfly pays 6.88. All of them had limited risk, but the one with the closest break even was the butterfly. You had to move the shortest distance for that to be profitable. It's because we paid the least for it. Second was the call spread, and third was the call. The call had to move the furthest to be profitable. So we have a spread that has a defined risk. We know the most we can lose is 48 cents. It has the closest break even, and it has the biggest reward to risk. Now, say if the market kept going if like SPY really took off, the call would have the potential to do the best. You're starting to talk about 2, 3, 4, 5 standard deviation events. The fly has a better chance of hitting than the long call does because it's closer. And we can do these big. We can do these really big. We know exactly what we can lose. We can just manage the trade. So that's the secret strategy. Did you know that? Do you know how to use it? Because if you didn't know about it, and if you don't know how to use it, you got to be able to manage these things. You got to understand not only how to get into them, but you got to understand how to manage them and get out of them. If this is new to you, or you find this really interesting, we have our volatility playbook workshop coming up in which we teach you how to turn market chaos into big winning trades. One of the great things about butterflies is they actually work really well in high volatility markets. If a market is super volatile and you think that there's a chance that the market will reverse and the volatility will come off, butterflies can be phenomenal. So that's what we're going to teach you. We're going to teach you how to use these in ways that you can have limited risk, very low margin, big upside, can put them on in chaotic, high volatility situations and then benefit when they calm down. Most people can't trade in high volatility situations because they can't handle the risk. You know exactly what your risk is. So if you find this interesting, check out the landing page on this course. This course is going to be unbelievable. We're going to teach you a system that we have traded, again, back to 2014. It's got amazing statistics. It's got a really good win rate. It's very safe, and it doesn't take much time. It checks virtually every box. Hey, what day is it? That's right, it's Tuesday. It's not just any Tuesday. It's Trader Tip Tuesday on the road, where I come to you with tips like this of understanding what a secret strategy is that hedge funds use to be able to put on massive positions and get around the algos. A strategy that could take you and take your performance to an elite level. So I'll see you next Tuesday.